So if you think about the current economic backdrop and bonds, what role do they play in that backdrop? For a number of years, it's fair to say that bonds have been on the back burner. So prior to the COVID period, you had record low bond yields, you had very low cash rates. So if you invested in a bond, the return you were getting, arguably on a forward-looking basis, was not that attractive, right? So it was not the place to be. Follow that, then you go through that COVID period, you have geopolitical unrest, for example, in Russia invading Ukraine, and you saw inflation pick up rapidly in a very short space of time. And we saw cash rates and bond yields go up as you saw central banks trying to get a lid on inflation. But in that type of environment, it also caused a lot of volatility, not only in equities, but also in bond markets. So, one period you had low, not a lot of return, and then suddenly you've got a lot of volatility, which again, for bond investors is not that attractive. But if we look at today, where we are today, and we have seen inflation moderate, we're not out of the woods there, but it has certainly moderated, and it's far more stable in terms of where we are. And bond yields now, if you look at things like US Treasuries, for example, are offering above 4%. So if you think about where cash rates are, where bond yields are, it's actually it's a reasonable rate of return now compared to a few years ago. So certainly there's a couple of elements there that are far more attractive for bonds today than the last couple of years. So bonds have a number of key benefits, and primarily the first one is diversification. And if you sort of think about that regime shift that we've had from low interest rates, high interest rates, low bond yields to high bond yields, in that environment, we did see a lot of volatility in bonds, and bonds were actually positively correlated to equities. When you had that environment, bonds actually didn't play that diversification role, which for many investors was maybe the first time they experienced that. But as we've seen inflation moderate and volatility in bond markets subside a little bit as well, we have seen the correlation between bonds and equities go down, meaning that the diversification benefit of having bonds in a portfolio has re-emerged, and that's a real foundational point for why you have bonds in a portfolio. Secondly, yields. As I mentioned earlier, the bond yields now are far more attractive. So the yield return you are getting for investing in bonds is comparable to other investments, and it's worthy consideration. So you are actually being rewarded for holding bonds. And then related to that also, if we continue to see inflation moderate and if we continue to see cash rates come down, now there's still a question mark in terms of what that path looks like. But if we do see that and bond yields come down eventually, then that will also be positive for bond investors from a capital appreciation. It sounds counterintuitive, but as bond yields go down from a capital perspective, it's a positive thing for investments in bonds. And then finally, valuations. So if we think about valuations and between equities and bonds, even within bonds, if you think about the broader bond market, you've got different types of bonds. So you've got, for example, government bonds, your more traditional bonds. You can have credit, you can have high yield. Within that spectrum of asset classes, certainly government bonds on pure valuation look far more attractive than they have in a long time. So that's another attractive point for bond investment on a forward-looking basis.